And I want to, change gears and discuss an area that is of great importance, especially to the business world, and that is managing risk. Of course, quite relatively a new branch in terms of management, the traditional management of the corporate world. And speaking to joining me now is David Tattam, who is an author in the area of risk management. He has written a book actually on operational risk, and he's also a specialist in the area of risk. He has traveled the world, and so he will be sharing his experiences to us about how companies, be they small, medium or large corporates, can manage their risk. Many thanks, David, for joining us on PM Live.
Thank you, it's a pleasure.
All right, David, I've done a small research and study on you, and you've written quite extensively, traveled the world speaking about risk and specifically, operational risk. Why is this area so passionate and so close to your heart?
I think it's an area that is untapped in the sense of the value it can add to an organisation, and I guess we look at it from two angles. One is what I might call the deliberate risk events, such as corruption, fraud, and those things that I guess make an individual think about themselves only rather than the collective. And so a lot of risk management is about getting the organisation to think more collectively for the good of the group, and a lot of that comes down to risk, fraud, corruption and so on. And the second part is what I call accidental risk, which are all the things that we experience every day: tripping over power cords, power failures, IT failures, and in the same token that can detract an awful lot of value from the organisation. If you put the two of those together, there is a huge value add to come out of it. And I think, to finish with on that comment, is that risk is often seen as a negative thing, but there's a huge opportunity managing it properly. So I'm passionate about it because of the value it can add, and I think it's quite untapped.
Quite interesting. Of course, I'll be coming to talk to you a bit about the aspect of a risk being an opportunity. But when you look at most companies, where I started by saying it tends to be quite a relatively new area in most organizations, other than especially the financial sector. Many companies for long didn't consider even having so much of a risk department. Why are we having all this new energy to look and establish risk departments?
I think there's probably two main drivers from it. Number one is I think that the general public have become a lot more aware of risk as we've become more globalised, and I guess almost going back to 9/11 when the public were thrust in their faces terrorist risk. Since that we've had many corporate disasters, particularly out of the US, so I think the general public's become a lot more aware of it. I think the other side of it is that in certain industries it's been legislated against, in the sense of the banking industry with the Basel framework. The banks had to do something, and it finally kind of managed to put funds towards it to say we need to do something. And I think since that has come in, people have now started to realise the value add of it, and it's now starting to encroach across all industries, all businesses, all government, and people are now wanting it rather than it having pushed on them because of seeing the value that it can create.
Of course, we're beginning to discuss the details about what you do, and of course the various categorizations of risk that you're giving, and of course how they can be mitigated, because every company out there wants to know how they can minimize their risk and have their sustainability assured in the long term. But what I want to ask is, for the companies, of course there are a few laggards, really, if you may call them so, who are not taking any effort towards addressing and thinking in terms of risk so much. How is it for them?
I think the history of business is scattered with the result of people like that, and I think it's also true that some organisations say they are doing the right thing, yet down at the coalface something very different is happening. And I guess Enron would be a great example, where at the highest level all the things they said about their risk management was fantastic. They were doing all the right things on paper, but then when you look down at what was really going on, it was a very different story. So I think that a lot of those organisations, obviously we've got lots of examples of doing it wrongly. What we're realising now is the importance of a practical approach to risk management rather than perhaps what I call a policy or theoretical approach. We have to absolutely embed it in the business and have people passionate about it, rather than perhaps doing what we call a tick and flick exercise, that we'll do it but we'll just tick it off as being done but not really believe in it.
So from what I hear you say is, more and more people are beginning to see the benefit themselves and not having, the governments or the authorities coming on their back and telling them you must do A, B, C, D, but beginning to see the benefits of, having a robust or, a dynamic risk management team.
It's very much so, and I think we had Professor Mervyn King at a conference the last 2 days, and one of the things he mentioned was that risk management cannot be legislated for. and that is really the compliance approach. And from that perspective, compliance itself is important, but it's restricted to what the person who's generating the compliance questions are. And if you miss something major, you'll have a real risk problem. So I think risk management has to come from a passion inside people rather than being told what they have to do. Otherwise, it will not be successful.
You mentioned an area that, of course, are becoming a bit later, talking about legislation, because there are those who, view weak corporate governance, or even which results in many risks as also being a failure in terms of legislation. But even before we get to that, you mentioned an aspect. You gave the example of September 11, and when you look at sort of that, and even some of the other what we call natural disasters, can risks in such areas be mitigated?
Definitely. I mean, I guess it's the fear we all have of natural things. Coming from Australia, in our region, we've had a proliferation of disasters with the Christchurch earthquake. We've had floods, we've had hurricanes, we've had everything thrown at business. And the result has been afterwards looking at how resilient we were. So we can't avoid a tsunami, we can't avoid an earthquake, but it's really how resilient we are in the way we've built our buildings, in where we've put our disaster recovery sites, and how quickly we can respond to those disasters. So I think risk management in terms of disaster is really all about resilience and how quickly you can recover from that disaster, which leads to the value that you lose, or the value, I should say, that you don't lose in the organisation. If you're not prepared, it can demolish and destroy an organisation. If you are prepared, hopefully you can mitigate it to a point that is reasonable and you can at least continue.
You've been in Nairobi for a couple of days now, and you're addressing a conference, the whole areas of risk. Of course, we didn't pay to attend your conference, but we wouldn't still mind benefiting from some of the things that you're talking about. So in a nutshell, what are the issues and the topics that you're addressing in the conference that you're doing with our sister newspaper, Business Daily?
Yes, so our Risk Africa 2011 conference has really taken about 3 or 4 directions. The first one was the most of yesterday, dealt with by Professor Jane Onsongo from the Anti-Corruption Commission, was speaking very much about corruption and the importance of an anti-corruption approach to business, and the ways that could be done, and many experiences that they've come across of organisations that are suffering badly from it. That was followed by Professor Mervyn King from South Africa, author of the King 1, 2 and 3 reports, and he spent a lot of time talking about corporate governance, getting the organisation right in terms of the board, getting the right culture, tone at the top. Then this morning we had Terry Downs, the CEO of Seneca, talking about security risk, followed by my colleague in Kenya, Gilbert Walidi, talking about fraud risk management, and I, as soon as I leave here, talking about enterprise risk management. So we've tried to cover a lot of bases in 2 days, and hopefully that gives our participants a flavour of what risk management is all about.
All right. Let's recently I saw a report by the World Bank that was suggesting that a couple, actually I guess it said many of African companies and even the listed companies had quite a weak corporate governance in terms of all the things, how they follow their policies, their laws, their procedures. And I know I don't know if you have done any global survey, or from your experience in the world, how does Africa compare with the rest of the world in terms of its corporate governance and also risk management?
I guess I come from a privileged country, Australia, in terms of risk management. I am initially English, but I spent 24 years in Australia, and we're quite proud in the sense that I believe Australia globally is in one of the world leaders in risk management, not least because the international standard on risk management, ISO 31000, was actually developed from the Australian-New Zealand 4360 standard, and it was chosen as the best standard. So I think Australia has done incredibly well in risk management, and even in the global financial crisis it performed extremely well. So I come from a very privileged area, and as a firm we've developed within that area, which is very competitive, but hopefully our products and what we do is good. If I then compare it to other countries in the world, and maybe I'll pick just maybe 2, the US and Africa. If we look at the US, they survived, I guess, a lot worse off in the global financial crisis, and when we ask why, I think the main issue a lot of people have spoken about is that the Americans followed a very quantitative approach. They built models, and if the model said jump, they jumped. If the model said don't, they didn't. Problem is all models are wrong, so they took a maybe less pragmatic approach to risk management. Also, corporate governance was obviously shown up as quite bad in the US in terms of perhaps a greed element, and culture. If I again come to Africa, I was here probably 6 or 7 years ago doing a lot of risk training, and it was very young then, and I've now revisited coming back last year, and I've seen a complete change in the attitude of Africa to risk management, so much so that we've now set up Protect Africa, and we see a huge opportunity here from both sides, for ourselves but also hopefully the value we can add to African business. And I am just actually amazed at the passion that Africa is now showing for risk management in such a short time. I believe there are a lot of practices which we'll all be aware of that are perhaps less than optimal around corruption, fraud, maybe the view of not working towards the collective but of the individual. But I believe that now the attitude of Africa, particularly Kenya, is fantastic in relation to towards risk management and where I think we can go. And I guess the constitutional change last year, I think, has given a lot of impetus to that, and people are feeling that they can actually make a difference now. And I think risk management is a way of helping that difference change.
Is that passion shared by the government, or is it so much in the private sector, or how is the feeling that within the African governments?
Well, we're working for some government organisations, and certainly the ones we're working with are very passionate about risk management. So my sample size isn't huge, but the ones that I've spoken to are very, very passionate. So if that's anything to go by, and that is a good sample size, then I think you're going absolutely in the right direction, and a lot of great things can be done here, both government and private enterprise.
Of course, when you were starting the interview, you spoke about legislation, because there are those people who would argue, is it way corporate, corporate governance in a company X or Y ultimately is affected by the rule of law in any country, and of course the two tend to impact each other in a way or two. In a couple of countries in this region, we've seen a bit of weak governance, even in terms of keeping the rule of law. And I want to ask, would companies in such areas be able to them have very strong corporate governance, whereas the environments and the markets within which they work may not necessarily have such a strong regard for the rule of law?
Yeah, absolutely, and I think as a firm, for us coming to Africa, as a risk management firm, you can imagine that we have very strong values and ethics around things such as corruption and so on. And for us in Africa, we have a very, very strong policy that zero corruption. Wouldn't make sense as a risk management firm to do otherwise. And I think that illustrates what I believe in relation to legislation versus corporate governance and so on, that it has to come from people wanting to do the right thing. We can legislate, and that in many ways produces liability for, say, directors and so on, which maybe makes them listen a bit more. But at the end of the day, I think legislation can only go so far. It has to come from people wanting to do this, and the more people in Africa that say no, for example, to corruption, the more people that say we want risk management and do the right thing, it will slowly emanate through through government, through private enterprise. And I believe in Africa it's not going to be so slow because of the passion I mentioned earlier. So I'm not a big fan of legislation. I think it's a backstop, it's a last resort. It really has to come from a cultural thing. And I guess my last point on that comes down to tone at the top. We always talk about an important aspect of any business is its culture, and we always talk about the tone at the top of the board. If we expand that out to the country, it comes from the tone at the top in terms of the politicians, of government, and everything flows down. And I think there's a huge responsibility of politicians, government, to make things happen underneath them, because we want to look up and have good role models of all of the things that we've spoken about.
You're mentioning about legislation, of course, being the last resort and being the last fallback plan. And I would imagine that, of course, you counter that possibly by showing people the benefits that they see it themselves without necessarily having the government with a big stick coming behind them. From the trainings you've been doing here, what's your feeling? Is that you've mentioned cultural change a couple of times? Is it beginning to happen, or has it already happened in the couple of organizations that you've been working with?
I think it's happening. We're not there yet because they're large organisations, and something like that takes a long time to flow through. But certainly the senior people that we are dealing with, the tone at the top, very much that they are embracing this. They want the change, they want risk management, they see the benefits of it, and that I'm sure will emanate through the organisation. Where we struggle is where we deal with maybe the more line management, and they look up to the board and the senior management who are not interested. Then they are really going to struggle. So I come back to that issue again, tone at the top, and yes, it is changing definitely.
David, I'm sure possibly there are a couple of companies, and our viewers who are watching us, and they lead company X, company Y, or company Z, and they have no strategy, no policy regarding risk management, of course, and they're beginning to see the benefits of having one. What is the starting point?
I think the starting point is what I call preparing the ground, and preparing the ground is coming down to a lot of sometimes training of the board, training of senior management in what is risk. We always think we know what it is. It's a little bit of a complex beast. Secondly, what is risk management, and showing to them the benefits. So we always generally start off an assignment with embedding risk management with training. The second part is creating the structure, which is corporate governance, getting the board structure right, getting the risk management function correct, getting the reporting lines correct, making sure there's no conflict of interest. So getting what I call the structure right. That is also then backed up by policy, getting appropriate risk management policies in place. Once we've done that, we then go to the third element, which is the action. And the action is really putting in place the day-to-day processes that make risk management happen. I won't bore you with all of that, except to say that that is made up of about 4 or 5 specific processes. One we call risk and control self-assessment, where we literally self-assess the businesses in the organisation as to what their risks are, what their controls are, and therefore identifying the key risks. We follow that up with number 2, key risk indicators, where we start tracking lots of information around the organisation that indicates maybe something's wrong. The level of staff turnover, the level of hits on our website for denial of service attacks, the level of systems outages, the level of power cuts, all those kind of things where we're tracking symptoms of risk, jumping on it. Number 3 is incident management, managing incidents as efficiently and as effectively as we can, and also learning from our mistakes. Number 4 is compliance, making sure we comply with all external laws, regulations, also ensuring we comply with internal policies, procedures. And finally is what we call improvements, or continuous improvement, making sure we identify things that can make our organisation better in terms of risk management, and making sure they're put in place. That all then gets linked together through reporting, where we, out of all of that, produce ongoing reports that go up to management and board to give the board a good understanding of where we are with risk and where the issues are.
Sounds like for the companies that don't have such a function, so if you are suggesting a creation of an entirely new department. In an ideal situation, of course, that brings up the issue of a cost, of setting up and of managing the risk. In an ideal situation, how much does it cost to manage a risk? Of course, I know it would vary from sector to sector, but what's your feel about how much it would cost, for instance, a company that has nothing in terms of this, to move them from ground zero to an area that they have a functioning, and an effective risk management strategy?
I think there's a number of costs, but it's not as much as I think people believe. The first one is actually resources, so people. The key issue with risk management, it should be done by the people already in the organisation at the business level. And it's not about producing a big department of risk managers, and they are responsible. We have a very large organisation in Australia, 4,500 people, and literally 2 people have rolled out risk management across the whole organisation. So in terms of cost, 1 or 2 persons. In a lot of small organisations, 1 person is more than adequate. In terms of the addition, there is an implementation piece around training. Then there is the facilitation of the process, which can be done initially perhaps by Excel spreadsheets. They soon run out of steam, and then you move on to perhaps a system. In terms of total cost, typically an organisation would perhaps spend, and I will do it in Australian dollars to start with, and we'll think about Kenyan shillings. We would particularly see a small organisation would perhaps spend somewhere around 50,000 Australian dollars, which would be 5 million, is that correct? I'll have to get my decimal points right. And then ongoing in terms of a system, we have our own system, Protect.erm system, and that costs in the region for a very small organisation maybe between 1,000 and 2,000 Australian dollars a month. So we're looking at something like, 200,000 Kenyan shillings a month, something like that.
But I guess what you're saying is that, of course, it's quite, of course, a bit of cost, but you can't compare it with not having, any risk strategy at all. Of course, you started by saying, if you suffer a huge loss or risk and things go worse, it's of course going to blow up the entire organization.
That's exactly right. I mean, I think the issue with cost is I actually say, no, there is no cost. Why is there no cost? Because the benefits you will get out of this will exceed the cost of doing it. That could be reduced insurance premiums, reduced losses, and that in a very short space of time more than pays for the investment you have in risk management.
David, you've been a banker for quite a while. Also, I read in your profile, and of course, with banking sector, the financial sector, actually generally, we are seeing more and more adoption of ICT services, more and more of e-services are replacing all the traditional ways of doing things. And depending on who you ask, again, they see the issue a bit differently. There are those who feel that with more technologies, you're going to reduce some of the traditional risks, but you're also going to have now to contend with a bit of more the modern risks. What are your thoughts in terms of the more adoption of technology, especially in the financial sectors?
I think it goes both ways, in the sense that introducing more technology can greatly reduce the human risk elements of corruption, human error, if it's done properly. The problem is, on the other side, when you introduce technology, it also increases the risk of fraud and corruption. And the issue there is it's easy for the fraudster, because if they do a small, what I call leak from the system, and it's not being really noticed, because the system just does the same thing over and over again, that can accumulate a lot of money without people really noticing. I think the other thing with obviously systems, it also opens up ourselves to external fraud. We can have perhaps a Russian hacker getting hold of our company value, where without those IT we wouldn't. So it goes both ways. So I always say that really with IT, as long as you do it incredibly well, it will dramatically reduce your risk. But if you do it poorly, it could end up in the end increasing your risk. So
what is the starting point again here in terms of buffing up and ensuring that in as much as you tap into any organization that is tapping to more and more ICT, that they don't become unnecessarily exposed, as you are talking about?
I think the whole issue is about protection, security. It's about securing those IT systems, and that comes down to firewalls, encryptions, antivirus, all those kind of things. And that is a difficult area, because the fraudsters are always trying to get one step ahead. So it's a never-ending battle with the external fraudsters. So from that perspective, I think that the main important thing to focus on is all about data security and protecting yourself. Now, one of the things we're seeing creep in globally is a move to what we call cloudware. So this is where the company would not have their systems internally, they would utilise systems externally. Now, there's a lot of fear in that, in sending data external to the company, but progressively we're finding that is in many ways more secure, because the external provider of that service has spent a huge amount of money, technology on security, which is a lot bigger budget than perhaps the individual SME might have, and therefore in fact it can in many ways reduce the risk. There is also, though, the added risk of people hacking into that as it's transmitted, so encryption and so on. So I guess to sum that up, it can go both ways. If you do it incredibly well, reduce your risk. If you do it very poorly, it will definitely increase your risk.
David, as we draw to a close, when you speak about strong corporate governance, many people tend to focus to large corporates and to the main players of an economy. But again, like here you find in Kenya we keep talking about the SMEs as being the engine of growth, and we have thousands of them which are doing a fantastic job in the economy. How does their risk profile compare with the large corporates, in a special caution for small SMEs as compared to the big guys?
I don't think there's one particular rule that differentiates them. The only thing I would say, maybe a couple of characteristics that are different. The first one is, in smaller enterprises, it's much more difficult to segregate duties, and conflict of interest and lack of segregation is often a very big cause of risk. Obviously, if you have a fewer number of people, it's much harder to segregate the incompatible activities or incompatible duties, where in a larger organisation is a little bit easier. I think also in the smaller enterprise, we often see promotions and appointments at the higher level perhaps are not done so much on merit, perhaps rather more on maybe clubs or assisting your friend, and that is a huge problem, I think, in corporate governance, that people should be promoted, appointed purely based on their credentials and their merit and their skills, rather than perhaps who they know. So I think that is perhaps more prevalent in a smaller organisation than perhaps a larger one that has a little bit more of a more robust appointment mechanism and appointing staff and board members.
All right. Last question. Of course, again, I don't know if there has been a profiling of the certain sectors which are most risk prone, or again it depends with one's every sector has its own dynamics. There are certain sectors that if you are playing you are doing business with them, you should always be very spending sleepless nights. Are there some that should take a bit of comfort? What's your experience?
Obviously, being an ex-banker, I would say banking is right up there. The reason is the product we have is what everybody else wants, which is called money. So obviously the prevalence of fraud and people trying to extract value is very, very high. On the back of that, we're also being entrusted with the public's money, which is a huge responsibility. So I think in that area, you've really got to look at the risk management of your financial institution. The other areas I look at is where health is an issue, where it leads to human injury. And a lot of industries are like that, in the construction industry, in the oil petroleum industry, as we've seen with the likes of BP and so on. Those industries themselves, and those that have an environmental impact, we should be asking very big questions around their risk management. And if you look at something like BP and what happened and the massive environmental impact, the public needs to be asking a lot more questions of these organisations that can dramatically impact the environment, impact society, impact people, and dare I say lastly, take money away from us. So there's a lot of those industries.
All right, I meant that to be the last question, but let me just ask one more and ask for organizations really that don't know where they rank, in the sort of how risky or not risky it is. Of course, they may have an idea. The kind of thing that you're doing, the consultancy, is there something like auditing an environment or a certain business that possibly there may not be hitherto so much information before, and sort of being able to gauge and tell them how risky what they are doing is or not?
Very much so. It's a big part of what we do is what I might call the health check report, and also what we call a maturity report. And what that really does, it says how mature are they in risk management. We have this international standard ISO 31000, which you cannot be accredited to because it's a principle and a guideline, and a lot of it is done in terms of how close is the business to achieving the standards in that standard, and that is a very important aspect. And so yes, a starting point for a lot of businesses is where are we right now, how far do we need to go, and that is what we call a gap analysis, and it does set a nice blueprint for where they perhaps should take their risk management.
All right, David Tattam, many thanks for coming to PM Live.
Thank you.
We've been speaking to David Tattam, who is a specialist in the whole in the issue of risk management, and he's an author. He's written a book actually on operational risk, and he's giving his thoughts on how companies, be they small, big, or whichever tier they are, they can be able to manage their risks of what they are doing. And of course, he's emphasizing the points that every company, every business ought to have a functioning and a dynamic risk management strategy, and of course not only strategy in terms of books and papers, but something that is being implemented. Because if ultimately a company doesn't not implement and it's hit by whichever risks there is, it would bring down some possibly many years of work and a great company in standing, and affect so many other players and in the economy.